Don't let these dishonest financial advisors lie to you and rob you of a comfortable retirement. Those stupid buy and hold pie charts that they push on their clients don't work at all. Now, I'm outside the financial industry, so I can just tell you the truth about how bad the forward performance will be for them. You've seen these old standard pie charts that asset managers around the world are pushing their clientele through. Maybe not necessarily these assets or these allocations, but you get the point. I'm sure you've seen them at some point. These things actually don't work. I'm going to explain why they don't work, but more importantly, they will never work. There's no reason why it would work. So the main thing that people could do if they wanted to default to the absolute baseline is what's called the VBanks, the Vanguard VBanks. So this is a 60% stocks, 40% bonds, balanced index fund, Vanguard product, very low fees. People could do this. 8.24%. This is, of course, during certainly a pretty strong bull market from 2012 up until today. Obviously, there's been a few hiccups, but 8%, it's never going to get any better than this. And to be honest, the long-term return, because of course it was down 37, 38% in the financial crisis, the long-term results are significantly worse than this. But this is the absolute best that it could ever be, basically, the 8% return. And there's other variations that people like to do. Other asset managers will try to throw their little spin on things, right? Add some gold. They think, well, you've got some precious metals. Maybe that'll help a little bit. So a 50, 30, 20, is that any better? Well, no, not really. Within 1%, it's like 7 and a bit. And again, during a bull market. So expect significantly less. Hedge funds, HFRI Hedge Fund Composite Index. Of course, this is a combination of several different investing styles. Is this any better? Well, no, not really. Essentially, the point, what I'm getting at is everybody's got their own little style and everybody is trying to shift these assets around into different allocations. The expected return of all of these things is not going to be any better. There's different names. People call them, the Ray Dalio all-weather portfolio. You got the dragon portfolio, cockroach portfolio. I've heard the couch potato portfolio. Basically, it's just somebody taking their own spin. As I said, insert cool name portfolio. They're basically just shifting these things around slightly. And then it's up to the marketing teams to dive in there and explain to everybody why their allocation, their magic formula is going to suddenly be better than everybody else's. But the truth is that the discrepancy here is going to be, plus or minus 1%, because all you're doing is you're just taking a bunch of assets, you're putting them in a pile, and yeah, you can shift them around a little bit, but there's really no difference between all of these, and we can see that in the performance. So what is actually happening? Why is that? Because the marketing teams, they're not going to tell you this. They're going to say, no, this one's going to go up, and then this one's going to be hedging a little bit, stocks and bonds, inverse correlation. They're going to make it sound really cool. But the problem is the baseline underlying assets, they all suffer the same thing. Now, all of them have good periods of performance. There's nothing wrong with the stock market during a bull market. In fact, I've always said that it's actually difficult to beat the stock market when it's raging higher. But that's not always the case. Of course, it has had 50% drawdowns and more in the past, which can take 5 to 10 years to recover from. So you have to actually look at the entire landscape, because remember, 90% plus of the world is just investing in these buy and hold pie charts. And it doesn't really matter what combination you're doing, you're subject to the same issue. US Treasuries, there are periods where they perform well, obviously, but there are also periods where they perform disastrously. This is the same thing as stocks. Can't hold it all the time. Gold. A lot of people think gold is the missing key piece, raging inflation or whatever, but gold can go 10 years without making any forward progress. And of course, you have to include the whole thing. Other assets, real estate, same thing. You get the point that sure, there's certain periods where it's doing great, but there are other periods where, what are we doing? We're just stuffing this thing in a portfolio. And what good is that? It's not really going to be doing anything. And this is really the crux of the issue, is that you've heard the saying that there's no such thing as free money. That's essentially what they're trying to convince people, is that there is free money for some reason. You just throw a bunch of assets in a big pile and hold them all together, and somehow that's going to produce some results. Why would that be the case? You've got a bunch of asset classes that have a long-term rate of return of anywhere from 2 to 3% on the low side, maybe 8 or 9% for equities on the high side. It doesn't really matter how you mix them all up. It's all going to kind of condense down to the middle. middle, and you're going to get plus or minus 1% bouncing around that 6 or 7 range, right? What if inflation is, according to the government, maybe 4.5% long term, but I think we can all agree that those numbers are a little fudged. If you're getting 6 or 7% return on your buy and hold pie chart, regardless of what it's called, the all-weather or the cockroach, it all sounds great, but you're not even outpacing inflation. And this is kind of why people get to the end of their investing horizon and they wonder, well, what's going on? This is basically the money that I just saved myself. There was no compounding. Well, why is that? You're getting the same rate of return as the inflation rate. Again, why would you expect anything different? There's no such thing as free money. You can't just pile a bunch of stuff and say, look, it's going to produce something. Why would it, right? That's the point. And I say this all the time. This seems rather obvious to me, but if you want to beat the stock market, you have to do something different than the stock market, don't you? The investment world is not set up to help the client. It's set up brilliantly to help the asset manager. And kind of the dirty little secret of the asset management world, the clients are getting basically no return when you back out inflation, but millions of asset managers around the world are making millions of dollars, right? They've got mansions and penthouses overlooking Central Park in New York or Chicago, Singapore, Zurich. They're all over the world making tons of money. Well, we've got a retirement crisis on our hands. The average person has about $250,000 in retirement. I don't know about you, but that's not going to stretch very far. And then you've got the statistics, half of people are living paycheck to paycheck. Well, asset managers are certainly doing fantastic. But again, why would you expect to beat the market if you're not doing something different? So this is where it comes to my work and why it looks so radically different. But the reason that we do it this way is, again, we have to decouple completely from the stock market and do something different if we want to beat it. So that's what we do. My portfolio is 4 independent strategies. And when I say independent, I don't take any trades in any one of them based on anything I've got going in the other one. So defensive rotation, traded independently on its own. I'll never take a position here because I've got a certain position here. These are all independently traded. And then when you put them together, that's the power of the portfolio. The tactical volatility strategy, you could call this our flagship because I'm kind of the volatility guy. This is a short volatility strategy. But of course, you can't just short volatility all the time. That would be as silly as expecting that you could just hold the S&P 500 all the time and expect to just, don't worry about the 56% drawdown in the financial crisis. Don't worry about the 50% in the dot-com bust that literally inflation adjusted took 15 years to recover from. It took from 2000 to 2015 to just break even on an inflation adjusted basis. That's not good. So obviously you can't short volatility all the time. And so that's why we use our volatility metrics. So we're checking a bunch of things about the VIX futures market, cash VIX. All of these indicators together are what allows me to decide what the strategies are actually doing. So volatility, essentially it's circled around the volatility ETFs. Obviously we want to short this. We don't use the VXX directly. We use the SVXY, but it's the same concept. Something that's down nearly 100%. Obviously we want to short this thing, but we have to be smart about it. We have to have a middle ground of gold where it's kind of ambiguous. Gold is actually not a very good asset, to be honest, but there are times when it performs well. And it turns out the times that it does best is during that ambiguous mid to high volatility range. So we can hold it there and we don't get punished. And then of course, long volatility, extremely important. It's very rare. We're only long volatility maybe 2 to 3% of the time, but there are times where you have to actually flip that switch and go long. The defensive rotation is a NASDAQ centered strategy. Essentially the NASDAQ, at least in the last several years, has radically outperformed the S&P 500. But again, you can't just buy and hold this thing. Otherwise, you're going to take those massive drawdowns. The QQQ itself, just the NASDAQ, not even leveraged, was down 78% in the dot-com bust. You don't want that to happen to you. It will take 17 years to recover from that. So of course, we have to cycle out into utilities and bonds and cash to make sure that we're only allocated during the high percentage times. So that's the second strategy. The third strategy, iron condors, this one is interesting because again, most people's portfolios don't have anything in there that can profit unless the market is specifically going up. You're holding all these assets, you need them to actually go up in order to profit. But an iron condor is interesting because it can actually profit from a lack of movement in the underlying. So we have to have exposure in our portfolio to make sure that we're always having something that can maybe make a little bit of profit, even if the stock market isn't going up. And don't let the options fool you. It's actually very easy. It's just a single click transaction. mentioned, you can definitely learn iron condors. And again, reminder, there is a full course teaching every single aspect of iron condors. So anybody can keep up with that, I assure you. And then the last strategy is called our strategic tail risk for a reason. We need another strategy, not only to target different assets, but also to make sure that we have some long volatility exposure. Again, not very often, but when necessary, it can be invaluable. So for example, this is the 2008 crisis. The S&P 500 was down 56%. You can see the VIXM, which is a midterm futures volatility ETF that we use in the strategy. You can see it did quite well. And this would feel great, of course, if the market is melting down and your portfolio actually has something that's rocketing higher. The old buy and hold crowd, what are they going to do? Well, everything is correlated to equities, basically. In a crisis, everything kind of goes the same direction, and they're down, 40, 50%, whatever it is. And you got to wait several years to break even. I would rather be a little bit strategic with our strategies and avoid that from happening. That's the portfolio. These are independent strategies, each with their own built-in risk management. And of course, if you want to beat the market, you have to do something different than the market. That's the whole point. These people that are expecting to just throw something in the mix and miraculously come out on the other side beating the inflation rate. I know, this is not popular among the asset manager crowd. I know a lot of people kind of throw shade on me when I mention this, but the truth is it's not designed for the client, and it's designed to be very easy from a management perspective. Just kind of buy and hold, couple of irregular rebalances from time to time. You've got a team to onboard new clients. You've got people to help you do the basic stuff. Oftentimes they're even just peddling the bank products. There's virtually no work on the asset manager end, and that's why you see a lot of them just parked in front of their Twitter all day long, just tweeting. Yeah, they've got a lot of time on their hands and they're making a whole lot of money. Clients aren't, though. So there you go. That's the first little psychology of why I ended up being here with my investing style. It's just out of necessity. I have seen right from the beginning of my investment career that the status quo is the status quo for a reason. It works fantastically well for the traditional asset management people, but does not work at all for clients. So again, just quick reminder, there is a free trial to VTS. That's another thing too, little benefit to VTS. I don't think there's any asset managers that'll let you do a trial run of their business beforehand, but with me, it is as easy as just signing up for a free trial. No commitment. Click one button if you want to leave. If it's not for you, we'll part as friends, but there is a free trial on the website for anybody interested. So for an extensive volatility metrics dashboard updated daily, and to see all of the live trades for our tactical rotation and option strategies, click this link right here and claim your free trial to the VTS community. You're always welcome to join us anytime. See you next time.